Nedbank released its interim financial results today for the 6 months ended June 2025. The bank reported revenue up 4% at 36.4 billion rand, with diluted headline earnings per share coming in at 1,762 cents, up 7% on the year prior. The board has resolved to pay a gross interim dividend of 10 rand 28 cents a share, which is also an increase on last year. In its SENS statement this morning, the bank characterized the operating environment as a challenging one. Well, to take us behind the numbers, I'm joined by Jason Quinn. He's the Chief Executive at Nedbank. Thank you very much, Jason, for joining us. So you indicate that your headline earnings were driven in part by non-interest revenue, while net interest revenue was muted. What were the drivers behind these observations?
Thanks, Nompu. It's great to be with you and your viewers today. I think, firstly, the economy. You covered it quickly there, but when we were together in roundabout March, Nompu, we spoke, I guess, a bit more buoyantly about economic prospects for South Africa this year. So, for instance, at that stage, we thought GDP would be in the mid ones, like 1.5. And we haven't quite seen it play out like that. The first quarter GDP growth was actually flat, almost only 0.1%. And then we saw, the second quarter has also been tough. The uncertainties and volatilities around trade have emerged. And we sit here today with probably lower conviction on that second half. So we've moderated our guidance for economic growth this year to only 1%. We factored in quantitatively as much as possible with respect to how we see trade tariffs play out. But there's probably some downside risk against that. So that's one factor. There were some green shoots, though. So, we saw our deposits grow 10%, which is always a good sign for a bank. And I think that's got a lot to do with, the quality of our customer service, our digital offerings and the like. And we saw our lending grow 6%. And in areas like mortgage finance and vehicle and asset finance, we were able to take some share. So I think we navigated the half reasonably well. Nompu, it's also fair to say that business confidence and consumer confidence probably deteriorated a bit in the second half. The delays in the budget, I think, caused some companies who were busy with infrastructure decisions to delay those. So I think we see a really strong pipeline still of opportunity ahead of us, but we didn't quite see the benefits of all of the efforts we put in the first half yet.
So I see that your credit loss ratio came down to 81 basis points compared to 104 basis points in the same time last year. That's a positive development. What drove that? And you seem to suggest that you're seeing a healthier South African consumer in the period under review.
Yeah, so once again, starting with the macros, prime at 10.5 with the latest cut last week is a lot more conducive to consumer lending and their ability to repay. So that's a positive. Low inflation is also a positive. Nompu, look, last year we were at 104 basis points. We express our appetite for loan losses, or those charges, as you mentioned, to be between 60 basis points and 100 basis points. That's basically the charge compared to average assets. And last year we were outside of that range and our consumers were still really struggling. Whereas this year, we're squarely in the middle of that range. And Nompu, we're kind of guiding the market today that we expect that to improve further as consumers continue to deleverage. Like I said, the lower rates help that. We've also been very supportive of our clients in distress over the last couple of years because the rates were very high coming out of COVID, after that readjustment. And it's good to see consumers navigate the difficult environment the way they have in a responsible manner. I'm really proud of the way our colleagues have responded to supporting our customers over this period.
So what about the operational costs at the bank? Your cost-to-income ratio ticked up to 57.4%. Isn't that a little bit on the high side? Is that metric set to come down?
Yeah, so two parts. It's obviously a function of revenues and costs. There was more pressure on the revenue lines, as you've heard from me now. We've covered those off. On costs, we continue to invest heavily in our business. And we reward colleagues and retain colleagues. So we think we've got some of the best colleagues in the market. So there's a function of staff costs. There's also a function of technology costs, which is material. We're investing heavily in digital capability. But Nompu, the real reason that's at 9, the real reason the growth's at 9% is because we also acquired a business called Eqstra, which we've combined with our leasing business to create a scale opportunity. And if you had to exclude that part's only on the cost line. Our cost growth's only coming in at 6%. Oh, excuse me. So we would expect our cost income ratio, that 57, we've guided, over the medium term and long term, in fact, to get that to sort of the 50% level.
Yeah.
And that will be a function of growing our revenues, growing our customer numbers, growing advances and deposits, and running an efficient business. But Nedbank's had a good track record on cost management for some time. The 9% investment at the moment doesn't concern me. I think you could see it as quite a strategic play, continue to invest in our business.
Do feel free to take a quick sip of water while I ask my next question.
Do that. Thank you so much.
Do that. So what's the strategy with your rest of Africa operations? And I note that you say, as part of your overall strategy, you've decided to put up your interest in EcoBank Transnational Incorporated, which is a bank that renders financial services in West and Central Africa for sale. What's the rationale behind that, especially given that we're very optimistic that there's going to be a lot of growth on the continent? Why are you withdrawing from that?
So a couple of things. Firstly, we remain optimistic about the opportunities on the continent, Nompu, but more in particular in East Africa and Southern SADC Africa. We've had an investment in EcoBank for a number of years. Unfortunately, it's only a 21% stake, so it doesn't give us the opportunity to own or control that business. We would much rather own or control businesses we operate because we think we've got better ability to execute. It's also fair to say that, I guess the business case originally would have been that Nedbank and EcoBank would have collaborated to serve clients, to serve South African clients that were moving into West Africa, and many of our clients are no longer in West Africa. So this is a strategic decision by Nedbank to disinvest its 21% stake in EcoBank and redirect those funds and efforts into our existing businesses in South Africa, in SADC, in particular Namibia, where we see amazing opportunities with respect to LNG and resource finds. Same in Mozambique. We think that economy is going to show tremendous growth over the next 10 years. And then in East Africa, we're going to push into a greenfield strategy where we will start steadily with our corporate and investment banking business, playing to our strengths, such as in areas like infrastructure finance, project finance, fixed income, currencies, some trade finance over time, and continue to evaluate opportunities in East Africa. In Kenya, for instance, we would look to acquire businesses over time. At the moment, that we can't quite find an entry point that we can announce today. But basically what you're hearing me say is that, the EcoBank chapter is being put behind us. We're realizing value from that, protecting the residual value, and then reinvesting that and our efforts into South Africa and other complementary markets.
Understood. All right, Jason. Well, more questions to ask, but not enough time. But thank you so much for speaking to us. That was Jason Quinn. He's the Chief Executive at Nedbank.